Our perspective is that the European macroeconomy has actually outperformed initial expectations this year. If you rewind, everybody thought that Europe and the UK would enter a recession. That hasn't happened. We thought we'd have very high inflation for a long time. It's come down, and we thought we'd have 5 to 6% terminal interest rates. And again, we're probably more towards the end of the rate hike cycle than the beginning or the middle. So that being said, it's going to be a challenging year. And our perspective on this is we have 170 middle market companies in Europe, about 40 billion euros invested. We get monthly numbers from these businesses. They're holding up well. We're still seeing double-digit revenue growth. Companies are in good sectors and they're well performing. We are starting to see some margin pressure from inflation. In particular, on the labor side, these are people-intensive businesses. The labor markets are tight, but overall margins are hanging in there at roughly 22%. So overall, things are performing better than we thought coming into 2023.
Let's look at the credit side of things, because clearly if you look at also the recent ECB financial stability report, loans is just down tremendously, the biggest drop since the financial crisis. So how's demand for loans in your private space going?
So we would agree with the assessment that certainly overall M&A volumes are down. It's a factor of confidence from CEOs, and that's a bit challenged. However, the subject of the conference is private equity. Private equity is sitting on over 200 billion euros of uninvested capital in Europe that will need something like 200 billion of loans. They're eager to put that capital to work, especially in the middle market. And private capital providers like Ares in total have roughly 60 billion of uninvested capital. So there's a good supply-demand imbalance there. So we are seeing activity on the new LBO space. That's roughly half of our volumes. However, the other half is refinancings when companies have loans that come to term. And frankly, our view is that the banking sector, whether it's commercial banks, which are increasingly risk-off, really started back when the war broke out a year ago in February. It's been exacerbated by Silicon Valley Bank, by Credit Suisse merging with UBS. And the investment banks have been very, very quiet since last summer. New loan formation and underwriting has been stalled. Loan markets traded down. New CLO formation is weak. So for us, I think private capital providers in Europe are gaining market share versus other types of capital.
What does it mean for the pricing of those loans you're handing out? Because clearly, one could also argue there's loads of competition nowadays in your market, but how is pricing going?
Well, given the supply-demand characteristics look attractive, we are seeing risk-adjusted returns that look better than we've seen in decades. We're underwriting new first-lien senior loans in the low double digits, 10 to 13%. Part of that is the increase in the base rates that we've seen because all of our loans float. But in addition, we've been able to charge higher upfront fees and higher interest margins, particularly because competition from the banking sector has declined meaningfully.